Happy Monday to everyone. I hope everyone had a fantastic weekend. Fall is currently setting in. I feel like it's a little chilly in California, but I've heard that East Coast is definitely getting chilly out there. So excited to be here with you today. My name is Chanel Grisso, and I'm your head of platform education here at Sanctuary. And I am joined with two fantastic people that I just always have such a good time with. We have Marianne Bartels, our Chief Investment Strategist, and Josh Freeman, Managing Director and Head of Capital Markets. And today they are going to give you a Q4 outlook. So Marianne's going to give us just a broad market update, and Josh is going to take us through a capital markets outlook. This is really intended to be really conversational in nature, so we want you to go ahead and put your Q&A and questions in the chat window. We'll definitely be getting to a Q&A a little bit later in the webinar. But with that said, Marianne, I'm going to go ahead and pass it on over to you. Thank you for joining us today, Marianne.
Oh, thank you for having me, and thank you for everyone that has joined and joins later on the replay. So, this is the part of my career that I don't have a lot of fun. I'm not saying a lot of good things. And this is pretty normal. When I was educated by my aunt, and I always talk about Aunt B, which is Aunt Bernadette. She went to Wall Street in 1956. The economic cycle was pretty predictable when we had just-in-time inventory. You would have a strong economic growth. Companies would build up inventory. Things would get too strong. The Fed would raise rates. The companies had to reduce inventory. You went into a recession. You reset. Obviously, you had a bear market during that period of time, but you would reset and go into a bull market. It was almost predictable. In fact, you could measure it quantitatively that every 3.5, 4 years, you'd have a bear market and then go into a bull market. But ever since Greenspan and the central bank really helping markets, let's say, in terms of accommodation with lower interest rates, and then after the financial crisis, quantitative easing, and just-in-time inventory has changed the whole cycle. And where we are now in terms of the cycle is the economy's growing fast. We have a war, and I don't hear enough people talk about this. When you study what a war does to an economy, it creates shortages and it creates inflation. And not enough people they've kind of talked about it, but this is pretty typical of wartime. In fact, much of the inflation that we have is more supply side than demand side in terms of shortages. And because inflation has grown so rapidly, the Fed now is forced to do something. And this is the first time in my career, because when I first came in the business, the Fed didn't even tell you anything that they were thinking, right? The Fed was not transparent at all. This Fed is probably the most transparent I've ever seen in terms of everyone on the committee telling you exactly what they think, and they're all saying the same thing. And they're all saying, inflation's too high, we're raising rates. We've had one of the fastest paces of increases. We've had rates go up 300 basis points since March, which is basically within 6 months. And we're looking for November to have 75 basis points. I think it's a flip right now between 75 and 50 for December. I think data this week will kind of confirm what December is going to look like. We get third quarter GDP, which is the first print on Thursday, and the PCE, which is the price consumption expenditure, we get on Friday, which is the Fed's favorite measure to measure inflation. So I think all eyes will be on that. And I think that'll determine what the rate looks like in December and possibly going into the first quarter. Where we are in terms of equities is everybody knows the story. I don't think there's anything not to know. The only positive at the moment is earnings, because we've just started earnings season and it's early. Only, about 20% of the companies are reported. They're not a disaster, but they're not good either. So based on, it's almost 100 companies that reported, it's the weakest earnings season since the third quarter of 2020. So not a disaster, but weak. This will be a big week. We have 150 companies reporting this week. You have a lot of the FANG stocks, the big stocks reporting. You have Alphabet. You have Apple, which I think is going to be a very important one. You also have Meta reporting. But everybody knows the Fed's going to raise rates. Almost everyone knows that at least economic growth is going to slow down, and possibly a recession. The question is it a soft landing or a hard landing? That it's already priced in the markets. If you look at the sentiment data clearly shows that the market is positioned to the negative side. If you look at the markets, technically, we're getting positive divergences, meaning price momentum indicators are improving as the market was actually falling. And that is still the price momentum is still improving. So we can actually get a rally here, and the market's trying. The market wants to rally. It's just been kind of straddled between, the Fed speak and the rates, and economic data and everything. But I think if we can get any little positive news, I think the markets will rally. I don't think they rip. The best I think we can get up to on the S&P is around 4150, which would be a 15% rally. But I see no capitulation. If a reminder of capitulation is a day where the markets are down sharply, especially on the open, go down even more, rally, get up to they rally up into early morning, late afternoon, and close at the high. They don't have to close to the plus side, but they have to close at the high on the day. You have to have broad participation of breadth, but the real ingredient is explosive volume, not strong volume, explosive volume. And we just have not had that. And I do believe in this market, we're going to have capitulation. The risk that I see in the markets when I was this weekend going through a lot of the different areas of the market, the pocket that still seems at risk is technology. And I do think that this is a PE compression, that PE multiples on some of the bigger growth names still have to come down. And I'll give you for instance, if you look at the small cap space right now, we're trading around 14 times in terms of multiple. In tech, we're as high as 23. We're somewhere between 20 to 23 in terms of tech multiples. The S&P is around 16, 17 times. It kind of, depends on what data you're looking at. So I see the most vulnerable component to be tech. Semiconductors are going to be the biggest component in there, and it's really the leaders are the last to fall. Some say it's the generals last to fall. The other stock that I'm worried about is Apple. And if you look at the FANG stocks, on average, they're down, and this is excluding Apple, they're down around 36%. Apple's only down 19%. If there's anything in Apple's news that the market does not like, I view that as a stock that's at risk. What I see in terms of market behavior is, and the Fed, I really think the Fed is trying to pop the COVID asset bubble and bring asset prices down to pre-COVID levels, which is in that 3,300, 3,200 range. So the max downside risk that I'm getting at this time is around 3,200. Now, not everything looks bad. I would say small cap has probably completed most of its correction. The best performing sector is still energy. The sector's up way over 50%. It's up almost 60%, 60. And still the cheapest sector. And still the best looking pocket of the market in terms of broad base. What you look for a sector to retain its movement or leadership is you want many stocks participating. And energy has it in spades. Really looking good. The E&P stocks are probably the strongest in there, but the sector has a lot of legs, I think, to it. If you dive down and you look at the financials, because everybody says that banks do well in a higher interest rate environment because of their net interest margins, that's correct. But during a recession, they have to take a lot of loan loss reserves. So I think they're being pressured on that. And the risk is if we do have a recession, you're going to get bigger loan loss reserves. But even on the financial side, I think a lot of the decline is already kind of there. So I bring up energy and financials because those are the pockets that really represent value. And we've really preferred value over growth. And I still think that that's really the strategy that you want to follow. I think it's too early to pivot into the growth names. In terms of commodities, we've had sharp declines really across the complex. And obviously, crude oil has declined. And we've declined to a level where I'm actually getting technical buy signals, where I think the decline in energy might be complete. And that's not surprising because we're moving into the high demand period, right? We're moving into winter. So I could see WTI up around 100 to 110, which would continue to support the energy complex. In terms of commodities, not commodities, in terms of currencies and commodities tend to move in the opposite direction, right? Dollar goes down, commodities go up. Dollar goes up, commodity goes down. And that really, a lot of that is linked to gold. And when I really look at the dollar and the strength in the dollar, I don't think we've peaked yet. I think that you're going to get up to about 120 on the dollar index. And I still think that you're going to see pressure on the euro and the yen. Now, there was rumored intervention today by Japan. It really didn't do very much. I don't think Japan is trying to change the direction of the currency. I think they're trying to slow the pace down. Now, a bit of good news that recently just came out. It looks like the UK now has a new prime minister. So I think maybe we can put Truss and her administration behind. And that part of the market overseas, I think has calmed down a bit. Looking at the fixed income market, and I'm going to let Joss get into the minutia of it. But I think that 10-year Treasury yields are actually breaking out to the upside. Now, certainly they can retrace a little bit and go down, but I still think that there's going to be pressure for rates to move up on the fixed income spectrum. When we look for the terminal rate for the Fed, meaning, what's that rate that they want to get to before they stop hiking? Powell told you his rate was 4.6. I think the market is starting to come to the conclusion it might be as high as 5%. So between 4.6 and 5 seems to be the terminal rate forecast. So with the Fed still raising rates, I still think it's going to cause episodic volatility in both fixed income and in the equity market. Now, looking at what's called the MOVE Index, it actually comes out of Bank of America. It's a volatility measure for bonds. That doesn't look like it's peaked yet. Just like the VIX index doesn't look like it's actually peaked for equities. So I still think you should brace clients for episodic volatility. Markets haven't capitulated, but we will at some point get that. And the Fed will get to a point where they not only maybe hold rates, but are actually forced to lower rates. Now, if you look at the projections of where the Fed thinks they're going, they think that they'll reach a peak somewhere around the first or second quarter of next year. They'll hold there, and by the back half of next year, probably start lowering rates. So we will get to that point. And when the market starts sensing it's the last rate hike and that we're going to begin pivoting, that's when equities are likely to start taking off. So these are all guesstimates. I think somewhere between the end of the first quarter into the second quarter, hopefully we're at a point where we begin a healing process. So wherever we get capitulation, whether it is in the back half of this year or early first year, normally that level of capitulation has to get tested. And it can take months. It can even take up to 6 months of a basing process. I call that a healing process. And then eventually you'll go right into your bull market. Now, there's been concerns about liquidity in the fixed income market. Everybody's been talking about it. It's been confirmed that there's a lack of liquidity, but there's been no stress in the markets. What we saw the Treasury do was put out a trial balloon to the banks asking if it would be in their best interest to do what's called buybacks, share buybacks of treasuries. What that would do is add liquidity to the marketplace. So the Fed has told you they're not going to save the markets. In fact, I think what the Fed is trying to do is reduce the wealth effect by getting stocks down, by getting housing down. They want to hit employment, get wages down, because the consumer is still spending. And as long as the consumer is willing to pay the higher price, you have inflation. Get all of that down, have the consumer not feel wealthy, have the consumer wages go down. They're not going to spend for higher goods, and you can peak out in inflation. If you look at the CPI, they break out services versus goods. Goods is already rolled over in terms of pricing. It's the services side that has the pricing. If you look at Bank of America data, it tells you the consumer is still spending. In fact, on their quarterly earnings for Bank of America, Brian Moynihan was telling you they see the consumer as being fine. JP Morgan is saying that savings was very high because of the COVID and the payments that people got, but they're starting to see that spend go down, and they're anticipating that spend continuing to go down. So we've got to get the consumer into the place where they stop spending to be able to probably get a peak out in inflation. So in terms of rates, though, I don't think 60-40 is dead. We all know rates were zero. We all knew at some point rates would have to go up, maybe not this dramatically, but they're up, and they're up dramatically. So there's a lot of value now in the fixed income market, particularly on the short end. And we're starting to see a lot of money flood into, particularly in the treasury markets in the 3 month, probably to two to 3 month range. But I asked Josh to join because he knows the intricacies. He's seeing what everybody's doing in terms of not only treasuries, but corporates and munis. So I want to turn it over to Josh to really go into the minutia, because I think right now the more exciting time, believe it or not, is in the fixed income markets. So Josh, take it away.
Great, thank you. I haven't heard anyone say that in such a long time. We were in such a low rate environment that there was no competition between equities and fixed income. And you're starting to see a shift in that in a more normalized rate environment. I would agree, though, the amount of raises in this short period of time is something that we've never seen. So it's certainly been challenging, to say the least. But when you think about the different sectors of the market, and that's kind of what I want to hit on. First of all, in treasuries, the curve is certainly flat to inverted. You have basically 1, 2, 3, and 5 years all hovering around 4.40, 4.5%. You have the 10-year at 4.20 and the long bond at 4.32. And then when you look at the forward swap rates and kind of the projective rates down the curve, you have the 2-year topping out around 5, and then the long bond actually projecting out a little below 4. So I do think the 4.75 to 5% 2 to 5 year, and certainly even the 10-year is a very realistic scenario. The Fed seems incredibly clear on what they're trying to do, that they're going to raise rates until they cause some pain. And I don't really believe that we'll see until the first quarter of next year, sort of the remnants of what was done in the last 6 months. And so from that lagging perspective, it will be interesting to see when they hint or decide that they want to pause or that they want to slow down. So I know people ask sometimes, well, don't you want to take some of those long rates and lock those in if we expect at some point rates to come down? And although I don't disagree with that, I don't think we're there yet. I don't think you're going to want to lock in at this point in time on the longer end of the curve. So that's just a quick snapshot on taxables with respect to treasuries. With respect to corporates, we're really seeing a pickup in rates on that short end of the curve, specifically the 1 to 5 year. So if you look at investment grade, non-financial type corporates, Disney, McDonald's, General Dynamics, things like that, you're looking at 5 to 5.25% yields in that 3-year time frame. If you look at financials in that same time frame, Bank of America, Citigroup, Goldman, you name it, maybe 5, 5.5, 5.75. And then we've certainly seen a lot of the financials, the big banks, issue 3 to 5 year callable paper in the 6.25 to 6.75% range. So there's a huge pickup in yield, in our opinion, there in that 3 to 5 year time frame. Also, you've seen the banks issue a good amount of 12, 13, 15, and 18-month callable paper. And in that range, you're looking also in the 5 to 5.25% range. So from a taxable basis on, non-cyclical, non-financial, industrial, things like that, everything seems to be hovering in the 5.25 to 5.5. And then certainly, if you want to move out to the 5-year time frame, you can get north of 6%, which we find to be very attractive, especially given the fact that it's callable. People ask about high yield a little bit from that standpoint as well. And when you think about high yield, you're really not getting the pickup. And just to throw a couple of names out there, think about the high yield from like a Las Vegas Sands or from a Teva Pharmaceuticals. When you think about those industries or those companies specifically, you would expect to be really rewarded, but those 5-year bonds are yielding in the 6.5 to 7% range. When you can have a Goldman Sachs bond that yields 6.75 and a Teva or a Las Vegas Sands that yields just south of 7, you're not really rewarded. You're not rewarded yet from that standpoint. So as we move into this different economic cycle, if we do come into a recession, high yield is always on a case-by-case basis. You're certainly going to want to look at cash reserves and the ability to cover debt and things like that. But at this point in time, there's not a reward, at least in our opinion, for going into the high yield space. And then to talk about munis for just a couple of minutes, typically, historically, munis are going to trade 80 to 90 basis points back of treasuries or at a discount to treasuries because of that. After the financial crisis, what we saw for a long period of time is that municipal bonds and tax-exempt bonds were trading plus 100 to treasuries. We were in a low-rate environment. We were trying to figure out corporate stability, balance sheet stability, new rules about taking risk and balance sheet and things like that. And so for the longest time, you saw municipal bonds and tax-exempt securities trading plus 100 to treasuries. That's kind of normalized. If you go back to COVID, when really everything got thrown out, the baby with the bathwater, the debt market, but specifically the muni market, was hit very, very hard. As we've begun to sort of normalize and rates have come back up, now you're seeing that municipal bonds, trading back 100 basis points to treasuries. It's still in the shorter part of the curve. I would say in the 2 to 5 year part of the curve on municipal credits, you're in the 3.5% range, while treasuries are at 4.5%. So you're 100 back of treasuries. That's more in line with normal spreads and normal curves. That being said, we also like the 6 to 8 year final maturity tax exempt space in a callable nature. So there's some value to be had there, in our opinion. But when you think about going out past really 8 years, you're not being rewarded. The curve is certainly inverted, flat, best case scenario. So the muni market has really started to normalize from that standpoint. There's value to be had, 3.5% or so, again, on the shorter end of the curve. And some of that 6 to 8 year callable paper is where we see the value. So, from a taxable, whether it's treasuries, corporates, high yields, from a tax exempt basis on the muni side of things, there are a lot of opportunities. We're certainly seeing a pickup in the activity, the volumes and things like that, and we expect that to continue. But I would say that, certainly in the 2 to 10 year space on treasuries, we think rates are headed higher and approaching the 4.75% to 5% range. So I'll pause there and turn it back over to Mary Ann.
Thank you, Josh. Chanel, can we take some questions maybe?
You betcha, Marianne. I feel like there's so many good buzzwords I heard in both of what you guys were saying. It was I wrote it down, a COVID asset bubble. I hadn't heard that one before. And Marianne, you talked about being in a phase of healing. I loved that. So let's go ahead and open it up to the Q&A. Reminder, the Q&A window is up there at the top. Go ahead and put in your questions. So first, I'm going to do a few to Josh. So you talked a little bit about munis. Can you go into a little bit more detail about just the state of munis and maybe discuss the taxable part of the Treasury curve, the 1 to 3 and 3 to 5 year time frames?
Sure thing, and I'll start in reverse order there and talk about that 1 to 3 and 3 to 5 year time frame. You know, that right now again is where the value is. When you think about 1 to 3 years, everything hovering around 4.5. That being said, you know, we do think you'll see some ticks up in the 4.75 to 5 range. But when you get a little further and you start dropping below 4.25 and 4, going out 8, 10, 12 plus years, that doesn't make sense in our opinion. So from a taxable standpoint, we're really keeping everything in the 1 to 3, 1 to 5, 3 to 5 year time frame on a taxable nature, and that goes for your corporates and your investment grade as well. On the muni side of things, as I said, historically, you would see munis trade 80 to 90 basis points back of treasuries. And the reason they would trade back is because of that tax exempt, or what we would call tax equivalent yield. For a long time, they were trading 100 basis points over treasuries, which was very unusual. And that was really post financial crisis. So much of this has to do with, you know, the supply demand, all of the balance sheet and risks that came out of that crisis. We are back into a more normalized curve. So when you think about a 1 to 3 year treasury yielding 4.5, and you can have a 1 to 3 year municipal bond yielding 3.5, that taxable equivalent gets those yields to be a little closer. I will say that in this side of the muni market, that 6 to 8 year callable space, you can have 3.5% yield to call range. But if you do make it to that 6 to 8 maturity, your tax exempt yields bump up north of 4%. And that makes it a little more attractive than what you would see on a 6 to 8 year treasury. And so that's what we're seeing in that space. And that's where we're diverting some of those funds.
Great. Can you provide an update on the high yield market? Are you seeing any risk reward opportunities out there that investors can capitalize on?
You know, it's interesting, and I touched on that earlier. Really in that space, you know, historically, you would expect to see high yields trade 200, 300, 400 basis points above investment grade corps, and you're just not seeing that. You're seeing the investment grade corps hover in the 5.5 to 6.5 range. And some of the high yield names that we would view as needing a little due diligence or a little research are maybe 50 to 100 basis points over. So it's very much on a case-by-case basis. I think we saw even a little bit with the Credit Suisse situation, monitoring that. We saw the credit default swaps on Credit Suisse, you know, really spike into that 450 basis point range. Those have since come back down. But what we didn't see this time was a little different. It didn't translate and run into all of the other banks and all of the other financials. It was really sort of contained just to Credit Suisse. So you have to take high yield on a case-by-case basis. And generally speaking, we're not seeing the pickup in yield and not seeing a lot of risk reward there.
All right, Marianne, I'm going to turn it on over to you. Midterms are coming up. What's going to happen with the market? What are you thinking? Is there any impact that we can expect?
So I don't have the answer that everybody wants. And it sounds a little bad, but it really doesn't matter. Obviously, elections matter. But I think the best thing that you get out of the midterms is clarity, that the market could price in whatever the result is. Do we get gridlock in Washington? And if we get gridlock, the market will be very happy. When we study the cycles of the midterms, we get right after the election, we get a great rally. Now that combines with November and December really being the best seasonal months for the market. So we're approaching the 2 best months of performance within the whole year. So I think the midterms really just give us clarity and allow markets to move. It's interesting because October is the month where we get important lows. And so far, we have not gotten that. To have the market to really take off here would be unusual. We've kind of been trading in a range. And if the S&P can trade around 3810, you're going to hear technicians say that we have a mini breakout. And that mini breakout could get us up to, I think, 4150, which would be very unusual to have that start in October. But hey, this has been a very unusual year.
Thanks, Marianne. All right, so let's talk about consumer spending. We're heading into the holidays. What are your thoughts around that?
So if the consumer has money, what we've learned in the United States, the consumer spends. We just can't help ourselves. So based on the data out of Bank of America and JP Morgan, which are saying the consumer is spending and the consumer has money, Santa Claus is coming. Yeah, I don't think it's a Scrooge year. I think it's still a Santa Claus, maybe even, Rudolph year. So people may be a little bit more selective in what they purchase. They might be a lot more sensitive to what kind of companies. Obviously, trading down to discount stores. I would expect discount stores to do really, really well. What we're really seeing is LVMH, and I might be missing a letter, very, very, very high-end retailer, had great numbers when they reported. Luxury is doing very well. Low end is doing very well. Like a Costco, discounting, doing very well. So I think if you're in the tails of retailing, you can do well. If you're in the middle of retail, you're not going to do well.
All right, good to know. My daughter will be very happy to hear that Santa is still coming, regardless. So many of our advisors are headed into the end of the year. Clients and investors are headed into the end of the year. So many are doing review meetings and looking at their balance sheets. Anything that advisors or clients can do to just really prepare for those conversations, or anything that might be helpful for them?
I know this is not really going to be helpful, but it's the best answer I can give. You have to have patience. Bear markets stink. There's just not, unless you're short the market, it's just not fun. And this is a double whammy year. If you're in both stocks and bonds, it's been brutal. And the last time that happened was in the early 80s. And I think this is even worse than that time period in the early 80s. This is very, very unusual. But we had a very unusual circumstance when we had quantitative easing in a zero interest rate environment. I don't know how anyone thought we were going to get out of this without pain, right? We just didn't know when that pain was going to happen. Well, we do. We're in it now. But it's temporary. It's not permanent. And, we can get back to an asset allocation model where we can incorporate bonds. That's the positive, that it's short-term pain for long-term gain. And that it's going to take time and patience. And I think we have to have that patience at least through the first half of next year. And I think, there will be definitely brighter heads. That's why I brought my bull. I still believe in the bull. I still believe that this is a secular bull market, and that we will want to allocate back into the markets. We're going to go back into technology. Every car, we're moving to, EVs, whether you like it or not. The market, every major manufacturer has now told you they're moving towards EVs. I don't know about your car, but my car has so much technology in it, I don't even use all of it. You need chips for that. Chips are going into everything. So even though I think these stocks are still can go down maybe another 20%, some of them, it doesn't mean it's the end of the cycle, right? So it's time and patience. Another part of the market I didn't talk about was healthcare, right? Healthcare is probably another sector, particularly in pharmaceutical, that will continue to hold up very well. I think the market will stay focused on dividends, and you have the dividends in the healthcare space. Personally, I think consumer staple stocks are now too expensive. If I own them, I might stay with them because they have more defensive qualities. But when the market flips, we're going to have to sell all the defensives and go back into cyclicals. I still think it's too early to go into non-US markets, particularly the emerging markets. We saw over in China, where there is now a more concentrated control of power, and the market spoke very loudly. They did not like that. China is probably the cheapest that it's been in a very, very long time on a price to book basis. But given the events that have just occurred, I don't think you're going to see a lot of capital move into that market. I think the risk is that you're going to continue to see capital come out of that market. But the big trade that you'll probably have once markets calm down is going into international and emerging markets, but you also need the dollar to peak out. I don't think investors will be comfortable going into non-US investments unless they see a peak in the dollar. And then they can get the appreciation of the other currencies and appreciation of those other assets. But I still think that's too early. Again, I still see episodic volatility. It's kind of like a tricky time in the market right now. I could see the markets going down and not rallying in some ways, and I can see the markets rallying in some ways. And I think the market will look at the data to try to anticipate the Fed's next move. And if we can get any slight sign that maybe the Fed is only going to raise 50 basis points in December, I think the market can rally on that. Josh, would you agree with that?
I would agree, absolutely. And I think a lot, Chanel, to your other question, these are the conversations that, as we talk to our partner teams very regularly, that they're having with their clients, not hiding from this market, having these conversations, talking, for the first time in a long time about fixed income. You can talk about tax loss harvesting. You can be excited about higher yields. We've all been complaining about this low environment, and what do we do with our short-term cash management needs? These are the conversations that a lot of our teams are having with their clients about rates and yields, and we finally can pick up some interest while we wait and evaluate this equity market.
Thanks, Josh. We actually have some questions coming in. Question from Rory O'Hara. 10-year Treasury is at 4.2%. Do we think it can hit 5%? Will it stay there?
So I think you can.
Josh is laughing, but Marianne, go ahead.
I think at some point you can go to 5 to even 5.25 on the 10-year.
All right, Josh, do you agree or disagree on this one?
It's interesting. Marianne and we're really on the same page and on the same side of the table on a lot of these things. We talked just recently. I think 4.75 to 5 at that point in time, it's fair game. So certainly 5.25 is reasonable. But I certainly think it's going to attempt to make that 4.75 to 5% run.
All right. I think what you said earlier, Marianne, it's a short-term pain for a long-term gain is really the theme here. So as you head into Q4 and have those client conversations, to Josh's point, that just transparency and educating your client is so important to really make them feel heard and for them to really understand what may be happening within their portfolio. So I'm going to have the Q&A open for just another minute. Marianne and Josh, any last comments, thoughts, or anything that maybe we didn't discuss?
Josh, you have anything?
I really don't. I know we've covered a lot in a short amount of time. And
I'm going to do my Philly stat. Okay, the Phillies, right? They won.
Oh, we got to give the Philly stat.
Okay,
Marianne,
so
right.
This is a factoid. I heard this, so I can't back it up. It came from CNBC, but my head perked up when I heard this. Every time the Phillies have won the World Series, we have had a financial crisis. So, take that for what it is.
So compliance would have me tell you that past performance is not indicative of future returns, but there you have it, Marianne. So we're going with the Astros. That's the name of the game is what I think we're headed into, right? Good stuff. Well, want to thank Marianne and Josh for joining us today, and all of our partner firms joining us as well. If you have questions, please reach out to Marianne or Josh Freeman, and always reach out to me. We want to bring you more webinars like this, so please reach out to us and let us know what would be valuable for you and your clients. Want to thank everyone for joining us today, and we will all talk soon, and hopefully you can get on the Monday markets with Marianne, and stay safe, everyone, and we'll talk to everyone soon. Thanks, Josh. Thanks, Marianne.
Thanks.
Thank you.